I affectionately call it a death spiral. When you never have enough money to do anything, you're always making relatively short-term decisions that feel cheap in the moment and wind up being expensive down the line.
What about EBITDA? When do you think that a company in consumer should be or close to break even?
Is money should be raised to pour fuel on a fire that exists, not to find the fire. I always say that everything should look the same on the way up, but everything looks wildly different on the way back down. But when the shit hits the fan, it changes everything and it's different every time. They're going to lose their ass very often. Founders' ability, like the number one rule of CEO in a startup is don't die.
Hi, I'm Mike Gelb, and this is Consumer VC, where we talk about what it takes to invest in and build scalable consumer businesses. If you're enjoying the show, make sure to hit that subscribe button so you don't miss future episodes, and sign up for the newsletter at theconsumervc.com. I share a weekly roundup of the latest consumer fundraisers, launches, and you'll be the first to know when a new episode drops too. Now, what really happens when a startup goes from raising big rounds of capital to fighting for survival? Well, that's what we're diving into today. Our guest is Stephen Finn, who's a partner and one of the co-founders at Siddhi Capital. Stephen's been in the room for some of the toughest conversations around down rounds, recaps, and cap table restructuring. We cover what to do when growth stalls, how to think about debt versus equity, and how founders can protect themselves in a restructure. If you want the unfiltered truth about what happens when things go wrong in venture, this episode is for you. But before we get into today's episode, I want to tell you about our episode sponsor, Glimpse. Glimpse is an AI-powered end-to-end deductions management service focused on recovering revenue from KeHE, UNFI, Amazon, and Target for consumer brands. They centralize deductions with backups, they fully handle disputing on your behalf, and they streamline the accounting process. And without further ado, here's Stephen. Stephen, thanks so much for joining me today. How are you?
I am great. Thanks for having me. Always a pleasure.
Oh, please. Thank you so much for coming on and for taking the time. Really appreciate it. So I know you have a fair bit of experience with down rounds, recaps, and cap table engineering. So we're going to talk about really when things go wrong on this episode and also and how to handle it.
Sure.
So cool. So I know you've been in the room when brands go from celebrating rounds to survival mode. What's really happening when the growth plan stops working?
Yeah, I mean, there's usually a bunch of people in the room who all think that the growth plan stops working for different reasons, and it usually takes too long to figure out that there's a problem, which is the kind of first issue. But yeah, I mean, what happens most often, I would say, is fundraising is truly a slog. It's probably worse than it's ever been. It's the same on our end going out into institutional LPs, by the way. And I think often startups, and rightfully so, see closing a round as a finish line instead of a starting line. And it's the wrong attitude to close your round with. And then they get kind of, cash in the bank, a little bit complacent, and depending on how much they've raised or what they're intending to do with it, once things start to not go perfectly to plan, depending on how much cushion has been built into the plans, I affectionately call it a death spiral.
Yeah, that makes a lot of sense. Do you think that there should be a mind shift overall within consumer brands in let's actually try to raise the minimal amount of capital for our product rather than we need cash, we need to make sure we always have cash on hand, we need to make sure we have a lot of capital. Like what do you think the mind shift is? I mean, now I know it's kind of different in this market as it was to a few years ago, so maybe that mind shift should happen, but would kind of love like your take on it.
Yeah, it kind of cuts both ways, right? We see what happens when companies way overcapitalize, right? And that can often turn into a disaster. We see what happens when companies way undercapitalize. I call it basically paying the hand-to-mouth tax, right? When you never have enough money to do anything, you're always making relatively short-term decisions that feel cheap in the moment and wind up being expensive down the line. I think the best way to think about how to raise money is to think about it in terms of runway to execute the plan, right? The more runway you have, the better, right? So when we see companies that are raising gigantic rounds and then hiring into a place or marketing into a place where they're now deploying that money way faster, that's not what I'm talking about, right? But when you have, investors like to see enough runway to make something make sense, right? So if you approach an investor who could be a small part of a round and you have 2 or 3 months in the bank, and asking them for money would get you to 4 or 5, that's a lot less attractive than if the same amount of money would get you to 18 months, right? So I think it's better to be fundraising earlier, and doing it from more of a position of strength so that you have more runway while doing it, so that the next investor feels like they're bolting on, month 18 instead of month 3, and they're going to have to be back at the table in 60 days. So it's less about amount and more about timing. Really, the earlier, the better.
Okay, no, that's really helpful. What tends to be the reason why a company maybe is not performing as well? Is it, for example, like, and I know that this is a broad question, but I know that you have a lot of experience, obviously, in food and beverage. Is it that like, what tends to be the reasons? For example, maybe velocities have slowed. Could it also be that they've spent so much money on, or that when they first got into store, um they actually did a lot of discounting, and then when they actually try to sell a full price, it actually didn't work. Like, what are some of the reasons why, in your mind, the growth has slowed, and how does this also backtrack into how you think about evaluating brands? What type of numbers, metrics you all like to see to kind of, not that growth can slow, growth of course can slow,
Yeah.
but to maybe hedge against that okay, this is actually a promising company.
So let me start by telling you about me, right? So Siddhi Capital, we invest really in 2 buckets. One is consumer food and beverage brands, and one is kind of food tech, B2B ingredients, things like that. I really run the food tech ingredient side of
Yeah.
what we do. So I spend a lot less of my time dealing with brands than the rest of my team, who might be better suited to answer questions about velocity and discounts,
Yeah.
things like that. What I tend to see as sort of a generalist fundraising comment is money should be raised to pour fuel on a fire that exists, not to find the fire, right? So when in our world, when we're investing in consumer brands, our kind of blurry line in the sand, and I say blurry because it means different things for different categories, different margin profiles, all that, right, is product market fit, right? If you really know that you have a product that people love and you can get repeat customers, right, and you're of a scale where making small but efficient operational changes will have a meaningful impact on the bottom line, and you're just seeking now to acquire more customers because you have a really good sense of who is going to stick around and what the return on that acquisition will be, that's when we get excited, right? Earlier than that, we generally find it's a shot in the dark. And the problem that you're describing is, I'd say, happens most often when brands go chase every door, and when they view, right, thinking again about starting line and finish line, right? Getting into the retailer is not the finish line. You got to get your stuff off the shelf. Otherwise, you're going to wind up discounting it. You're going to wind up hurting your margins. You're going to wind up getting kicked out. And it's a lot harder to get into a retailer the second time.
That makes sense. That makes sense. Well, I mean, for fuel to the fire, when you say venture dollars should be used to as fuel to the fire, where should those venture dollars go? Like, for example, should that money be used for inventory? Should that money be used for marketing? When does it make sense to actually use debt versus equity to actually fuel what you currently have going?
Starting from the end of it, it makes sense to use debt when you can get debt. And those who are underwriting debt deals don't like to do very risky things, right? So I think the availability of debt to produce inventory or to do anything like that, right, is
Well,
it is
I kind of feel like the debt markets really have also come downstream, in that there's now a lot more kind of options to actually get debt when you're smaller. I think that the problem is, of course, like the APR is extraordinarily high, right? Which obviously that balances out the risk, right? But it does seem like there are opportunities if you want to explore.
but that's fair. There's stuff like
When you
revenue based financing. I
Yeah.
agree. There are options. Many are predatory, right? But I think sometimes doing it in equity super early in a depressed market can also feel that way, right? It's just about sort of a blended cost of capital, right? So
Right.
I think it's, if you can get reasonable debt, maybe is a better way to put it, right? Because you have some genuine collateral or reason to back it up, right? If you have POs and you can get debt on the inventory that you know is going to sell, that makes sense, right? If you're taking on like revenue-based financing loans to go buy a bunch of D2C customers that'll perform unpredictably, that's when I start to have a problem with it, right? I think that when you're doing just like on the D2C thread, right? If you're focused on when should you raise equity dollars for D2C, it's when you have something that's genuinely repeatable, where you have and D2C is all over the place and ebbs and flows every day, and we've seen most of our D2C brands transition to being kind of retail first. But just speaking from an early stage pure play D2C perspective, right? You need to figure out at some level of scalability what your acquisition costs are going to be and what your lifetime values are going to be. And that's all kind of table stakes. The really important thing for understanding debt versus equity is understanding what the payback period on acquiring a customer is.
Mm-hmm.
Where if you like lifetime values are great, but if it takes 15 years for them to materialize, you're putting out a lot of cash up front to wait for all of that to come around. Right. So it's about how fast can I return the cash to the coffers. And the faster I can do that, the more likely debt can successfully underwrite that.
No, that's a fair point. I mean, I think it's really kind of understanding what your inventory cycle is, right?
Yes.
Which is maybe the exact same thing. But understanding, what the turnaround time. I mean, B2B, it's a bit more predictable, if that's fair to say, even though there is still unpredictability within B2B for sure. But you have POs kind of coming in, and also it's probably easier to get a lender when you also have POs. Not that there is,
It's about, yeah, lenders in B2B are about credit worthiness of your counterparty.
right, exactly,
You have that.
exactly.
You can usually finance POs.
Totally, totally. And I think that what's, you know, interesting is even when the rate is really, really high, there's, and, certainly can be considered predatory or is predatory. There is actually also this balance too, where it's okay, but if we also raise more equity, right, long term, then we're
That's
for something else. So
that's
yeah,
some of the equity deals we've seen could also be seen as just as predatory, right? I think
yeah,
your willingness to take on predatory debt in that way should be a function of really how confident you are you can sell it through with the speed you think you can sell it through, and then gross margins, right? Because when you're going to raise equity money, most of the time in consumer, it boils down to some level of revenue multiple, right? And that revenue multiple gets impacted by the market. It gets impacted by the growth rate, right? The faster you're growing, the more likely you are to use, this year's projection as the base for your revenue multiple instead of last year's actuals, right? There's a little bit of wiggle room around what you're multiplying. And if you can use debt without bleeding money to increase revenue meaningfully in a way that you understand is kind of temporary, but that you'll have margins that you can then claw back when you have the money to support it, I think that's a decent place to be.
what are equity deals that you believe are predatory?
I Everything's worth what someone's willing to pay for it.
It also always takes two to tango, right?
Yep, 100%. So I don't blame anybody for their crazy term sheet. Most of the time, equity deals that make me say, "Oh wow, that's kind of intense," are from insiders in companies that have both completely failed to meet expectations and tapped out the vast majority of their insiders. So what winds up happening is someone raises their hand and says, "I can fund this," but nobody's coming on a free ride with me.
So usually it comes from a recap or some type of
That's
restructuring.
that's when I've seen, yeah, the most intense, weirdest terms for sure is when people are coming in mad as opposed to coming in looking for, a good deal in a net new company.
Got it. Got it. Yeah, that makes so usually that first fundraise, the first round of capital that's in, normally you might not have some of the kind of terms that you believe are predatory. It's more so when the brand already maybe has raised some money, but then but then are kind of within dire straits. That's when kind of, and it really is maybe a distressed asset. That's when it really is some of it.
I always say that everything should look the same on the way up, but everything looks wildly different on the way back down, right? And that depends on the circumstances, right? So on the way up, if you're arguing about anything beyond valuation, I think that's weird, right? You're usually like pretty straightforward docs, NVCA, right? The relatively standard looking equity rounds, safes, notes, right? All of those on the way up while you're very excited about a net new company should be pretty clean and pretty fair. But when the shit hits the fan, it changes everything and it's different every time.
Do you think when a company fundraises, which term do you think is stressed as the most important, but maybe actually isn't the most important, or one that you think is not important that founders should actually be thinking a lot more about?
I'm generally not fussed on structure at all, right? I don't care if it's an equity round or a note or a safe for the most part. I think they all can be written to get both sides to the same place, right? So when I see investors that only do equity rounds or whatever, I always think that that's kind of nonsense. In terms of like actual terms, I mean, liquidation preferences can sometimes get pretty brutal um, when they exceed like two, really.
Yes. Yes.
But like, and I guess that's a good one. That is an example of what I might view as predatory on the way up. That someone comes in net new and puts a 2x pref on it. I usually don't like that, but it's usually unless you get to extreme downside cases, it's not going to be the thing that makes it so nobody gets paid.
Yeah, I mean, that's what I think is interesting because because I look at, obviously, just like you, all the fundraisers that happened, daily. And of course, you don't know the rest of the terms, but you look at a company and you look at a wild valuation that is, there, but hey, maybe they agreed to a 3x pref, right? In terms of the company, because they wanted to optimize that valuation. Well,
Or maybe there's a put, right? I've seen deals that are wildly overpriced on paper, but are done by almost debt-like investors who are seeking to get a return, right? So I've seen one that was like, it started with a 1.5x liquidation preference. The liquidation preference ticked up over 5 years, and at the end of 5 years, they could put it for the value of the 3x pref, right? And that made sense because the company was super profitable. The round was relatively small. And the bet really from the company was we will have enough cash in 5 years to pay this out 3x. And the bet from the investor was much more like a we're targeting 15% IRR debt deal, right? And that worked for everybody, but the sticker price was relatively insane.
right, right. No, that's a great example. Yeah. Well, I know that you've seen, obviously, companies raise like 20 million, 40 million plus, but then they end up restructuring, right? When this happens, what's typically the underlying issue?
When companies way overcapitalize, and you know it when you see it, right? Company that's not too far along raises 100 million to go take over the world. It comes from SoftBank or Andreessen or something like that.
Right.
One of these kind of mega funds that's designed to build a portfolio that either dies or takes the whole market. What winds up happening is let's say a company is doing a couple million in sales, right? They're worth maybe 4 or 5 tops X their top line, right? That we I think we're kind of seeing deals done right now in the 2 to 4-ish revenue multiple range.
Yeah.
And that, like I said, is what you're multiplying depends on your growth rate and a lot of other things and founders' previous success. But if you're worth, let's say you're doing, extreme example, 3 million top line in some kind of sexy category, and SoftBank comes in with 100 million, right? It would not work if they came in with 100 million on 15 million pre, right? So that's not the deal that gets done. So you wind up needing to ratchet up valuation so that you can account for dilution and make it seem like a more normal venture round, even though it's way too big, right? So you now have a valuation that is set way too relatively high for the actual, where the company sits, and a whole pile of money that's supposed to help offset that, right? And allow the company to achieve outsized growth or outsized distribution or whatever it may be to grow into that valuation. It just doesn't work that often, right? It works sometimes. And it's honestly structurally not designed to always work, right? These mega funds know when they're doing that they're going to lose their ass very often. But in the ones where they get to take the whole market, it pays off, right? So they're structurally designed to do that. And when it doesn't work, they are great at cutting and running. The big guys, right? They know if they way overcapitalize something and it's not a hit, not to way overcapitalize it twice. They move on to the next shiny object, right? So you wind up with a company that's raised way too much money. It has a giant valuation. It also has a giant liquidation preference stack, right? That company that was worth 15 million, even if you set the valuation at 300, right, and you bring in 100 million and now you're 400 million post money, when that gets reset, there's still $100 million of liquidation preference there, right? So if I'm coming in and resetting that and I'm saying this is worth $1 pre-money, it's actually $100,001 before I see my second dollar, right? So that's when the structure of the cap table gets so broken that without being completely rethought from the ground up, it's going to be a real problem, right? And if you don't take off immediately after raising one of these mega fund rounds, you wind up with a valuation that you can never hit expectations, right? So new money that's approaching this is always then approaching a down round with a weird cap table, and there's always going to be scars on this thing. That makes it harder to raise the next round, even if you're coming back to industry insiders and away from the mega funds or whatever it may be. Every investor wants, when those mega funds come in, they're looking to 5+X that deal, right? So now they've invested in you at a 400 million post money valuation. That means they're setting $2 billion exit aspirations for you, or it didn't work, right? So that causes all of that 100 million to go into excessive hiring, really getting out there, really focused on increasing revenue, often at the expense of good revenue, at the expense of margins. Companies wind up doing product line extensions to leverage the space they already have into spaces where they don't belong, right? And then it's hard to shed all that, right? When someone decides it's not working and we're running out of money and we need to raise more, the burn is way too high for anybody new, particularly from the industry, to come look at it. So that's when I think the really aggressive recaps come in. The mega funds need to get really recapped out. The expectations need to be completely reset. And when the expectations are reset, you need to be looking at the liquidation preferences and all the way back down. So it's just an unraveling death spiral.
No, that makes sense in terms of the flywheel of death. I feel like the mega funds, putting all that money into a company that maybe shouldn't, that maybe is way too early to receive that money, or really doesn't have the traction or the not that they don't have the growth, but they don't quite have the markers there where it actually makes sense to actually deploy that much money so quickly. It's really kind of an option bet, right? It's just an option bet to make sure that you're early, and that you're in for, even though the price is high, but you're in early. It's just kind of an option. So if it doesn't work, let's move on to the next company. And
that's what makes it so easy to walk away from, right? When our main fund does a relatively big deal for us, we are in it, and we're gonna fight to make it work. We're not gonna cut and run, right? It's just a different model.
So let's say you invest in a fund at the Series A level, right? And the company raises a massive Series B. Does that make you nervous?
Yes, it does. For all the reasons I just laid out, right? It is. My friend Rob Go from Next View Ventures did a great post on LinkedIn about what he called, I think, the great re-risking, right? And that's what happens, right? When you raise too much money at too high a valuation and set those crazy expectations in the stratosphere, that you've re-risked the company completely, right? Typically, as you're going from seed to A to B, you're stepping through stages of de-risking the company on a path to a normal exit. When you change what the outcome needs to be considered a success, you're stepping backwards in risk profile, and that's where it really scares the crap out of us.
Yeah, that makes sense. Well, how also does it change cap table dynamics and also preference when that does happen? And when a company raises a reasonable Series A and then massive Series B, and then let's say it doesn't really quite go as well, how does that kind of restructuring come together?
Yeah, and we've had a number of CPGs that followed this model, and a number of tech companies too, right? Where they raised normal looking rounds in maybe 2019, 2020, and then maybe a stupid one in 2021 or early 2022. And they're still really working through that, I'd say, right? So generally, the first thing that needs to change for this to work at all is a reimagining of expectations, right? That when that big Series B you're describing happens, those Series B investors still want to 5x. As it stops going well, we get to a point where those Series B investors are focused on recovering their money, right? When you get to that stage of acceptance of where the thing is at, and the vibe changes from we need to knock this out of the park to holy shit, we need to get our cash back, that's when you can start making these adjustments. Right. So I think that without that, the Series B investor better have a lot more money to keep funneling in, because nobody's gonna go in behind a crazy valuation and a bunch of missed numbers. Right. And that's why I think it becomes more risky, is you really put this thing on a pedestal such that it has to hit its numbers perfectly or it's a disaster. It unravels from there, like I said, kind of differently every time, right? What it really depends on, as you start thinking about, how do I recap this? How do I get this to a place where expectations are now reduced to normal, and where outcomes can be logical for, the next money to get their return and all the old money to get full or partial recovery? Right? The things you really have to consider are, whose signatures do I need to get a deal through?
So that's kind of the first step in terms of whose signatures do you need?
Yeah, it's really three at once, right? It's who's around the table externally who could be interested, who's around the table internally who would put up a little bit to save the old, right? And the math there is really, if the shit has hit the fan, can I put up $1 now to fully recover my old $5? That math works out if you've written off the old in your mind, and then the new one gets good returns. Does that make sense?
Yes.
And then the third thing is really about, what signatures do I need, right? And then from there, my goal always is to create a cap table and a round that reflects where the business actually is, and almost retroactively looks like it always looked like it reflected where the business actually is, right? So if a company raises a $500 million Series B, to throw a stupid number out there, but they should have raised a much smaller one, we're going to have to eliminate that liquidation preference, right? And then they're going to have too much stock, and we're going to have to offset that by dramatically expanding the option pool for the team, right? So now you get to a place where this company has, 10 or 15 million in liquidation preference overhang, and a team that owns approximately what it would have if that last round never happened. And those are the kinds of levers that you start to pull, in my opinion, to create that alignment around where you are today.
And just walk me through expanding the option pool. Is the reason why you do that because you obviously want the team to still be motivated to actually run the company, and so they have obviously more equity, since when you join a startup you really are obviously you have a salary, but typically it's because it's because in terms of where your income is going to get, it is going to really be meaningful. It's probably going to be more on the equity side. So is it to kind of keep all employees motivated and obviously happy?
Yes, it's also to avoid debt equity, right? The equity on your cap table should be owned by those who are pushing the company forward. So if you have a mega fund Series B investor who shows up with 100 million, owns 40% of your company, and then vanishes off the face of the earth, they are debt equity. They are not helping, right? So they are not helping because they own too much, and because they create way too much of a liquidation preference overhang. So the way to deal with that is to basically get them to accept that this is a loser and that there's a path to partial recovery, eliminate their liquidation preference and bounce them down into common stock, and then dilute them by expanding the option pool for those who are showing up every day. Now you have but it's key, if you need their signature, which you almost always do, to be presenting a story that can get them to partial or complete recovery at 1x, right? And if you can tell that story, you can really wiggle around the rest of it.
How do you tell an investor that they're dead equity?
You ask them to put up more money, and when they say no, you tell them they're dead equity, right?
Okay.
You convince someone that they're dead equity by convincing them that in the absence of a round, they are at a zero and that they are standing in the way of a round, right? So you have to basically work on the psychology that gets them to believe that 0.2x is better than zero, and here is a path to 0.2x that actually genuinely makes sense.
Got it.
Right? You prove to them that the thing they created is unfundable.
Right. And also, I mean, with also being unfundable, they actually also refuse to keep funding it as well. So it's kind of, so it's also,
And that's a huge problem with the mega funds, right? It feels great when Andreessen cuts you a big check, it feels really shitty when you have a bunch of conversations about why they're not following on with potentially net new money,
Right.
right? That's the double-edged sword.
Do you think as well we're also in a period where there's always pressure on companies? I'm not saying that there isn't, especially ones that are venture backed in terms of growth. But do you think that there's a new pressure also because ventures going through a little bit of a liquidity crisis, if that's fair to say, with LPs with LPs not really getting returns. A lot of private companies, right, that on paper are quite big, but at the same time, haven't gone public. You haven't gotten these exits, or haven't gotten these acquisitions. Some of the acquisitions have been blocked.
Yep.
What How does this kind of relate into does this relate at all in terms of liquidity when it comes to either restructuring or losing confidence in a company and you want and wanting to get your money out?
Yes.
The way I described to our LPs in our most recent update letter, how we have to operate now is we have to operate from a place of financing risk first, right? And we have to do that differently than we ever have before, because we're now in a market where even the best performing companies don't necessarily get that next round lined up, right? It's kind of that bad, right? So if that's the case, that means that we probably need to have more concentrated portfolios, because we need to be willing to put more money up for things that are working in the absence of it from the outside world, right? We just need to be able to do that. But it also means that we're generally, and I hate to say it's sad but true, right? But we need to be looking for things that are taking smaller swings, right? That have less of a cash need to get over a smaller hump, because we don't believe that the money's out there. All of that is driven by what you're saying, right? Which is institutional LPs are now a couple of years behind on getting the returns they've been promised, even if they're still there on paper. Often they're not. Funds are having a hard time raising their next fund. So I think, VC is taking it a little slower to both try to have their companies perform better in their current funds, but also to try to buy some time into what might be a better market, right? And that leaves us in a place where there's just less cash available.
So when you say finance risk first, I was just taking notes.
Yeah.
You mean concentrated portfolios, so you're not investing in as many companies, and you're investing in less companies, but having more, but also at the same time having more ownership in those companies.
Yeah. But I would say that the first question that we need to answer for ourselves in any net new investment now is, how many dollars does this company need before it does not need dollars anymore? And where do we expect those to come from? Right. That is not a conversation that we had anywhere near as specifically in 2019, when we were in a world where the great performers were going to be able to raise the next round from the outside world, and we didn't have to worry about them.
So finance risk first. So you obviously have concentrated portfolios. You have more share in these companies, but it's the less amount of, but it's but you aren't investing in as many companies. The return profile, let's say, it more looks like a growth equity PE return profile rather than a typical VC profile, if that's fair to say, and that is less risky. You don't have as many outliers, or the outliers aren't nearly as big.
We're not targeting 100x in any deal, right? If you were targeting 100x in consumer food, you'd be nuts. Uh, we need to do investments that mostly work, and we're kind of gunning for triples. That makes sense.
Yeah, no, totally. In terms of, I know that one of the questions that you just said that you ask is, how much more money would this company need after a round? Is the goal that when you invest, are you thinking, can this be the last equity round this company raises?
The trade-off is that when you are the last equity round the company raises, you're likely to get a lower return multiple, right? Because those future raises after you can accelerate valuation, can allow the thing to grow bigger, right? So it's not, is this
Not
the last equity round? It's, I led a Series B in a company a year and a half ago, right? And it was like a $25-ish million Series B. And we looked around the existing cap table at a bunch of very excited faces who were happily joining us in this round, and many were reserving money for future rounds, as we did as well. Right. So this was not the last round. There will be one or two more rounds in this company, but we have around the table was almost enough money to get the whole thing across the line to profitability, and then you take it from there, right? If we said, we're raising 25 million now, and the company needs 30 million more over the course of the next few years to get to profitable and then take it from there. Maybe we looked around the cap table and saw that 22 of the 30 were already there, right? That this guy's holding that much and that guy's holding that much and we're holding another 4 or 5 or whatever, right? So we saw a very clear path without needing to go find the magical Series C lead to getting the company all the way through where it needs to get. Not that was the last money in.
Yeah, that makes sense. That makes sense. How back to, I guess, on the restructuring side too, first of all, how do you communicate restructuring to the board and investors? But typically, who kind of starts the conversation of restructuring that, hey, things aren't going?
I try to.
You try to. Okay. So it's typically coming from the investor side. Has it ever come from the actual founder or operators that are part of the board?
Yes, it's the closer you get to cash out date, the more everybody gets creative. I pride myself on trying to see it far enough away that you can figure it out while there's still enough cash in the bank to get a deal done.
What, in terms of far enough cash in the bank, what's typically your timeline or how do you evaluate that?
I mean, we're seeing companies have a very hard time raising money with 6 or even 9 months of runway in the bank, right? So if you don't have real line of sight into where the next round's coming from, if it's not coming from insiders with 6 months left, it's time to start talking about how to compel your insiders to be your next round, or it may just all explode.
I'm sure you also get situations where an insider might say, okay, we can maybe do a recap. We'll put a little bit of money in, but maybe it's not meaningful. But we want to just put money in just to make sure externally it shows we haven't lost confidence. We can say, maybe it's 100K, maybe it's 50K, maybe
Yep.
it's just, not that much money. Has that worked? Does that ever work?
We've been that guy. It works when somebody's holding the bag, right? So if nobody's holding the bag and burns 200K a month and the last lead says, I'm going to put in 100K, it does not work, right? But
Okay.
if some confident insider has put up an inside term sheet or something, or put up enough money that we've now bought, past a year of runway, and the noteworthy members of the cap table kick in a couple of bucks for positive signaling, it buys some time. It's usually pretty transparent.
Got it. But to get someone externally then to come in, has that, when the insiders are only putting up a little bit of money, not maybe meaningful enough, does that typically work, or the optics just so bad that it probably won't?
It depends on, back to my comments earlier about runway. Outside investors, we have a rule at Siddhi that, of course, we violate all the time, but we really try not to, that we do not add a net new company to our portfolio without it having 18 months of runway, at least, right? We don't want to add something that has 6 months of runway and then in 2 months be worrying about where the next check's going to come from. The company needs to have some time to spread its wings and figure out its thing and execute its plan, right? So that's our perspective as outsiders. I think others share that perspective, right? So we do not, if we have enough cash to invest in this company 3 months of runway, we would like those to be months 17 through 19, not months 1 through 4, right? So if insiders can put enough money together such that we can come in from the outside and be that impactful runway extension, it's great. If they're kicking in, 3 days runway, expecting us to buy a couple months, it never works out.
Got it. That makes sense. That makes sense. Are down rounds still considered a scarlet letter, or is that changing?
I never view them as a scarlet letter. It depends on how they're executed, right? So a shitty recap would be the thing I described earlier, right? Companies raised $100 million. I'm just going to come in 1 million pre without adjusting for the past, and now I still need $102 million exit to 2x, right? It's not a scarlet letter, it's just a bad deal, right? But I think we've all now lived through such a ridiculous boom bust, maybe boom, but mostly bust cycle, that everybody understands that the world looked different 3-4 years ago. And if you can kind of elegantly craft a deal that is lower price but logical for today's situation without bringing the baggage of the past into it, I have no problem with that, and I like to write those.
Has how you invest, has that changed in terms of how you were investing 3 or 4 years ago? Because obviously the market overall was very different and changing. And so I'm kind of was just very different towards now in terms of the market was at an all-time high when it comes to valuations, right? If that's fair to say.
Yeah.
And now, of course, except of course maybe if you're AI. But if you're not an AI,
In our world, it's GLPs. If your GLP is your
yes. Oh,
stock
that's
stick,
fair. That's fair.
yeah.
That's fair. And yeah. No, that makes sense. Totally. How has your process or how you think about valuations, has that changed at all when it comes to 3 to 4 years ago to now?
Less in considering valuations and more in considering long-term fundraising plans for individual companies, right? It's we just really can't bank on the next guy being there, and that changes how we think about everything, right? If you look at early deals we did in, for example, cultivated meat, right? We did those alongside very, very deep pockets who came in with very little conviction and looking for option value, as you said earlier, right? So now when they don't materialize, and you know, not to make Andreessen my punching bag, but Andreessen leads a Series A in a cultivated meat company and puts in 25 or 30 million and is maybe, has access to all the money that the company would ever need to get to the finish line. That's less exciting than it's ever been today, and was super exciting in 2021 because we've seen how it plays out when things don't meet expectations.
So, I guess, and this makes sense. Seems like you're constantly having to also look over your shoulder, or or at least look over your shoulder a little bit in terms of, okay, what are the Series B, Series C players kind of doing, and what kind of metrics do they need in order to get comfortable, and how much maybe runway a company needs. That okay, when we actually look at companies now to invest in, we need to make sure that they're going to obviously have plenty of runway because it's not gonna kind of pull together. That's actually a really bad signal if they're running out of cash really quick.
Yeah, and they also just need to be businesses more than they ever have before, right? Margin is runway. Every margin dollar you have is an equity dollar you don't have to raise, right? And that is a bigger focus than it's ever been. I mean, we've always been pretty gross margin obsessed. It's really what is the difference between a business and not a business, in my opinion. And it's just now more impossible than it's ever been to scale into margins, right? So things that don't have good margins out of the gate and need to raise money to scale into them are going to have a hard time ever doing that.
What about EBITDA? When do you think that a company in consumer should be or close to break even or EBITDA positive? And you can even, if you want to break it down by different categories, for example, that's fine as well.
Yeah, it definitely depends. And it's like we'd like to see really solid gross margins. I'd say, depending on category, that could range anywhere from kind of 40 to 80, 90% net gross margins. Um, we probably spend less time in the categories that are closer to 40, right? When I say that our blurry line in the sand is product market fit, that is later in a cold chain beverage than it is in a high margin D2C friendly powder business, right? Because you
Right.
you have fewer options for distribution, and it's super expensive to do that distribution. You're shipping heavy things cold, right? There's lots of extra expenses around it. Profitability. I mean, if you're doing 100+ million and you're not doing it profitably, there's probably some problem there, uh, with likely your margin, and maybe you are in the wrong places and grew too fast and you know prematurely scaled. But yeah, it's really very different by category. I think it's we've seen businesses profitable at 1 million in sales. We've seen businesses unprofitable at 300 million in sales. It's tough one to answer.
How how also when you, let's say you have a distressed asset, a company isn't, doing so well, and how do you bring how do you think if there might be an opportunity to still sell this asset, right? And how do you go about, maybe this is more like an investment banker question, but how do you kind of bring that company to market to see, okay, let's figure out if there actually is a suitable company that might be interested in buying this, and how do you actually even market or promote the value that the company have in order to kind of bring together these two parties?
I think the first step is probably not to go out with something like that. It is to take the step back and try to adjust it into something that looks less distressed. And
So
through to kind of
so kind of first do like a recap, for
yeah.
example.
When we see companies that are either recapping or selling and they're not quite sure yet, I tell you right now, they're not selling.
Okay, okay, that's helpful.
Yeah. So getting that recap in place, getting whether it's a right sized team or right sized product portfolio, and really building a company that's capable of doubling down on what works instead of just constantly shooting for the moon. That's what makes it attractive. Bankers are good to bounce thoughts off of and figure out, you know, are there potential acquirers? What does this market look like now? What do comps look like now? But frankly, at the end of the day, they're all going to tell you they can sell your thing, and then some can and most can't. At least in our experience, right? Everyone is very positively inclined on the way in, and then it turns out it's a tough market. Um, so it's really, if you know who your prospective universe of acquirers are, you should go talk to them. If you don't, you probably have a problem in and of itself. Yeah, I think bankers are a very useful resource in understanding if there's a market for something, but take their yes with a little bit of a grain of salt. If that makes sense.
Yes, it does. It does. But also, I think the insight, at least here, is first do your recap. First, actually structure the business where it becomes where then you know that whatever valuation they kind of give in terms of or what that acquisition price is, which I know is negotiation, but whatever that ballpark is, that you're able to actually fulfill that, and that you have a much more clean cap table.
Yeah, I think that's right for everyone involved, right? Why would a founder push to sell something for 80 million with $100 million prep stack? What do they get out of that? Nothing, right? You have a serious misalignment problem if you try to sell the distressed thing with the weird cap table while it's distressed and with a weird cap table, right? Because you need the same signatures that you need to do the recap to do the exit, except now there's no hope.
Yeah. How are there? Do you have any favorite in terms of selling distressed assets, a distressed asset in consumer, and they're actually able to pull it around and turn it into an incredible brand?
I haven't seen much of it. There's a
Yeah,
couple
it's really hard.
of roll ups that will take in distressed brands and roll shared services over them. I
Yes.
think that's a conceptually good model. I think that can work. I think it's always hard to know when you're trying to catch a falling knife if it's fallen too far. And I've seen very little of those roll ups being able to successfully raise the money they need to actually leverage the shared services. Right. So they need to raise money too because they're bolting on unprofitable assets.
Right.
And it's not that's a tough sell. We've passed on a couple of them.
Yeah, I can imagine. I also feel like with roll-ups, yes, you can maybe streamline operations better and obviously get, margins a lot tighter for a lot of your companies. Maybe you're switching suppliers, so you're all using the same supplier, and then, you're actually able to get scale from that way or whatnot. At the same time, you still have to obviously sell and marketing, and that costs money to do so, and that's all still individual, right? It's not like you can really spread or share those costs where you have some type of, economies of scale in that way.
There are in the back end, there are in operations, there are in accounting, right? There's plenty of synergies and plenty of reasons why it should work, but you're 100% right. That's not where the bulk of the cash to grow is going.
Yeah,
And without that cash to grow, you're where you are.
totally. What are some smart ways founders, what are, or Are there smart ways for founders to protect themselves early so they aren't wiped out in a restructure?
Um, yeah, I mean, don't raise stupid rounds is a good one. Right. Don't raise aspirational rounds because you think it's the finish line and you get to post all over your LinkedIn. Right. That's the number one thing founders do to shoot themselves in the foot is accept stupid terms and stupid rounds. Right. So I think back to what I said earlier, raise the money you need for the timeline that makes sense, and really focus on raising the money that allows you to pour fuel on the fire that exists, right, and not go hire everyone in the world and go to every door and all that, right? So that's all important. Um, Trying to keep control of the board with the common is helpful. It's not that helpful because at the end of the day, typically we see preferred board members getting outsized control, and there's all kinds of, even if there's a board that's 6 common seats and 1 preferred, there's plenty of important decisions that need the preferred director's approval, right? So that's just like, it's a start, but it doesn't get you all the way. Um, it's really be super important to the company, right? The founders that are not super important to the company or screw it up or piss off investors are easy to get rid of from in a recap situation, right? And it happens all the time where we're gonna bring in cash and we're gonna bring in the new guns to run with the cash. Uh, if you think that's you, be more important. You know what I mean? Right? If you are the founder who is completely indispensable, you will always have the negotiating leverage.
Hmm. Hmm. No, that's fair because of course then you're irreplaceable, and so if yeah, that makes
And irreplaceable, right? That means that any recap, whether or not your signature is actually required, you should be thought of as a required signature, right? And those whose signatures are required to get something done get their pound of flesh every time, or nothing gets done.
yeah, that makes got it. Um, how how do you know when someone is still coachable, like a founder is coachable, even when their original plan has collapsed?
Ooh, when you see it, that's a tough one. But I mean, it's from a fundraising perspective. I am usually screaming early and often that we need to know where the next dollar is coming from. And if there's 3 to 6 months left in the bank and we still don't know and don't have good insight into where because the founder thinks it's going to be no problem, I've probably lost hope, um, in that founder's ability. Like the number one rule of CEO in a startup is don't die, right? Like
Don't run out of cash.
it's your job to not die, right? So if you can't look that in the face, you're not coachable enough for me. Um, and that is what it is. But yeah, I think that's a big one for me on the fundraising side. In terms of execution, that Einstein quote of insanity is the definition of insanity is doing the same thing over again and expecting different results, right? You know who's who. Then it's usually obvious pretty early.
How, I mean, because I'd imagine that some of the reason why retail businesses raise big rounds is, let's say they're doing really well in a region, or maybe they're in the natural channel, and then one of the big conventional um, retailers comes and says, "We're going to put you at every store." Blah blah blah. Blah. How do you? And maybe this might be more of a question to Melissa, but how do you all? And then of course it gets really tempting, right? Because you have a national retailer that is interested in you, wants to go national. So you then, and then of course you're pitching that to investors. Investors get very excited, and so you were able to kind of close this big round. And then even though you have the money, and maybe you actually did support the national rollout, it just the product didn't work in that store for whatever reason,
Yeah.
right? Maybe your prices were too high. Maybe it just didn't make sense.
Right, and in that example, the big conventional retailer who wants to take you in, I would look at their set for your thing, and if it doesn't exist, you're a question mark, and if it exists at a way lower price, you're a question mark, right? They don't know
Yes.
how it's going to go. I think that's just important to note.
Yeah, no, for sure, for sure. I would say, how do you how do you think about when you do have those companies, and maybe it's kind of that example of they raise a Series A with you, and then maybe they raise a massive Series B, and that's the reason why they raise a massive Series B. How do you think about what the growth journey maybe should look like for a retail business that will be successful in terms of growing slower? Is there a certain amount, for example, of number of stores that they should be in that again gives you an idea of, okay, now we should kind of, and velocity looking good, now we should expand, but we shouldn't expand too rapidly. How do you think about it from
It's
that?
more about the types of stores that they work in than the number of stores, right? And the demographics around it and what kind of marketing they're doing around actually driving traffic to those stores to get it. We have one of our best performing companies is a company called Circle, right? They have a water bottle with a pod that is the flavor pod, and it maybe behaves differently at different kinds of retailers because in some place like you need to buy the bottle to get into the ecosystem, and some retailers have massive water bottle businesses up against Stanley and Abwala and the other kinds of normal looking water bottles, and some retailers don't sell any water bottles, right? So that's what they have to then figure out is where should they be, right? Should it be in the places that sell the water bottles? Should they be the only water bottle in the place that doesn't sell the water bottles? Or should they only be a replenishment thing in those, right? So that's when you're something like that, it's a complicated undertaking, right? But for most kind of normal grocery products, it's just about where do you sit in your set and does your set move? And if your set moves around your prices, you should seek to be in those doors. But yeah, different for every kind of category.
That's great. That's great. What's my final question is, what's one book that's inspired you personally and one book that's inspired you professionally?
Whew. I would say the Lean Startup back in the day inspired me personally, just to like be a hacker and try shit and see where it goes and not put all eggs in one basket. In terms of professionally, this Essentialism, I forgot who wrote it. Greg something
I
Newey.
love that book.
Yeah, that really, we have an incredibly erratic business, right? We have deal flow that falls from the sky. We have companies that we need to deal with on a regular basis. And just even the picture on the cover of a circle with a bunch of arrows coming out of it, right, instead of like exerting all that effort to actually move the circle, that one was huge for me in terms of just really focusing on what matters. It's very, very easy to be distracted in our line of work.
Yes, I can only imagine because of course you have your LPs, you have of course obviously the founders that you're serving, you have new prospects, new prospective businesses that are coming to you looking for investment that you're doing analysis for. You also might have companies that on companies that might need recap or help in that regard. So there's a lot of things that you're kind of juggling, all of it. So that makes sense.
And the time sucks are not always where the time should go, right? Some of our best performers are the ones that we've put the least time into because they know how to do it, right? And some of the places where we put the most time, it winds up all being for nothing. Right. And then that's my one kind of call out curse that I have is I see a situation and I try to figure out the deal I'd still do in that situation. Many of those scenarios I should just let die.
Well, that's a great point in that you spend a lot of time with recaps, thinking about recaps and obviously how to do it. Does it even make sense to kind of spend time with those companies doing that instead of focusing and giving more time to the companies that actually are, you know, growing and winning?
It's got to be a balance. I don't think it's that different than doing a company the first time, right? Many, possibly even most will fail, but when it works, it was all worth it.
Great answer. Great answer. Stephen, thank you so much for your time. This is a lot of fun.
Yeah, thank you. Anytime.
Thank you. And there you have it. It was awesome having Stephen on the show. Thank you so much for listening. And please subscribe on whichever platform you're listening on so you are kept in the loop of the latest episodes. And check out the newsletter at theconsumervc.com. Thank you, Glimpse, for sponsoring this episode. And thanks for listening.